Hi everyone. Um, Welcome to our masterclass series on capital budgeting today. Um Capital budgeting is one of the important decisions which any firm makes. There are various types of decision making which happens within a company. One of them being where to deploy the capital, right? Usually there would be multiple choices which a firm has on where they can deploy the capital. So the firm needs to decide which is the most profitable project, which is the best way, which is the most efficient way to deploy the capital they have to produce maximum returns. So this technique of evaluating capital projects is known as capital budgeting. Capital budgeting may be defined as the firm's decision to invest its funds most efficiently in the long term assets in anticipation of expected cash flows. So, um, the challenge which every firm has is that there is limited amount of capital. So that means they cannot take up every project which they can do. So here they need to decide which project they should do and which project they should let go for now. So what is the most efficient way to deploy its funds? And when we say capital or funds, we are talking about debt and equity, right? So there are two forms of capital a company has, that is, one is equity financing and one is debt financing. So there are pros and cons associated with different sources of funds, and there is a cost of debt, there is a cost of capital. So accordingly, keeping everything in mind, uh, the funds the company has, uh, how they should decide where to deploy those funds in the most efficient manner, that is what we call as capital budgeting. For example, our finance ministry every year comes out with a budget. So they tell us that this is the budget for the country. Uh, this is how we will get the money, and this is how we will deploy the money, right? So on similar lines, a company also does that. That this is our debt financing, this is our equity financing, this is the cost of our financing, and accordingly what should we do with this capital so that we are able to generate more returns than the required rate of returns of our capital providers. That is how we can generate value in the firm. So as you can see in the image here, the company wants to decide whether we should pursue the building of this plant or not. The project cost is $10 million. uh, Now, what will this plant give us as returns for how long? So, all those things come into play while making the capital budgeting decision. What is the objective? Uh, the idea behind doing all this evaluation, doing this analysis is that we want to maximize shareholders' value, right? So, um, if we broadly talk about the structure of any organization, uh, on top we have the owners, uh, shareholders. Um then shareholders cannot look at day-to-day management of the firm, so they appoint board of directors. Board of directors also cannot do that, so they appoint top leadership management team. um, Top leadership management team appoints different managers, and below that we have other employees of the organization. So all of them are working towards creating more value for the firm, creating more value for the shareholders. Maximizing the shareholders' value is the objective with which all of those resources in the organization are working towards. Uh, so this is one of the most important decisions in terms of trying to maximize the shareholders' value. Features of capital budgeting decisions: exchange of current funds for future benefits. So what we are doing, we are deploying the funds we have currently for future benefits. So the funds are going out today, but the future benefits will accrue over next 3 years, 5 years, 10 years. So that is where time value of money comes in also, which we will be taking into account while looking at various capital budgeting techniques. Funds are invested in long-term assets. So here we are not talking about short-term decision making or working capital kind of decisions, right? So here we are not talking about which inventory supplier to choose, or from which company can we source the laptops. Those are more of smaller term or more of relatively smaller decisions. But here we are talking about long-term assets, fixed assets, or those investments which will generate returns over multiple years of time. So this is more of, that's why we call them capital projects or capital budgeting, because here we are talking about projects or investing in assets which will generate returns over more than 1 year, maybe 5 years, 10 years. Future benefits or cash flows will occur to the firm over a series of years. TVM comes into play. So as we discussed, we are making the investment today, but the benefits of those investments will come in next multiple years. So the money which is coming in later needs to be discounted back and evaluated in terms of the present value of benefits. So that is where time value of money comes into play. What is the importance of investment decisions? As we said, there are multiple reasons why these decisions are very important. First is they influence the firm's growth in the long run. So when we say long run, over multiple future years, how the firm will look like, what are the cash flows, what are the profits the company will be able to generate, will depend a lot upon what capital budgeting decisions the firm has made in previous years. So those decisions, whether they are turning out to be correct or not, that will determine how much growth the firm is able to see in the long term. They affect the risk of the firm. That means if the management has decided to enter into a risky venture, that can significantly impact the earnings, make the earnings more volatile, more unpredictable, and that can result in huge losses also if the project doesn't turn out to be the way the management thought out to be. So again, what is the risk involved in the project? That also can significantly affect the risk of the overall firm. Third, it involves a commitment of large amount of funds. So as we said, these are like investments into long-term assets, fixed assets. So a large amount of funds, a large amount of capital will be deployed in these fixed assets, and then they will give us benefits over multiple years. So we need to be very careful where we are deploying these, because this is a large amount of funds. Irreversible or reversible at a substantial loss. So it's not easy to take a U-turn after we have decided to go ahead. For example, a company has set up a factory. Then it's not easy to, after 1 year, decide that this is not working out, let's shut it down. So that could result in a substantial loss, right? So large amount of funds were invested. Now you may not find any buyer for that factory, or if somebody decides to buy also, it could be at a significant discount to the cost we incurred in setting up the factory. So these are not easy to reverse, and even if reversed, it will result in a substantial loss, and most difficult decisions to make. So that means because a lot is at stake, large amount of funds are invested, these are impacting the riskiness of the firm, these are not reversible, uh, and they are influencing the growth in the long run. So there is a lot at stake when we are making these decisions, and the capital is limited also. So once we have decided to deploy the capital for a particular project, it can have a significant impact in terms of where the company stands after a few years. So one of the most difficult decisions, need to be very well thought out decisions for the firm to make. Yeah. So let's look at these in more details. Firm's growth in the long term. First importance of investment decisions is it impacts the firm's growth in the long term. A firm's decision to invest in long-term assets has a significant impact on the rate and direction of its growth. Unwanted or unprofitable expansion of assets will result in huge operating costs to the firm. A wrong decision can make it hard for survival of the firm. On the other side, inadequate investment in assets would make it difficult to compete with peers. So these decisions impact the growth of the firm in the long term, right? For example, Aditya Birla Group has recently decided to enter into the paints industry. They have launched it through Birla Opus. That is a capital budgeting decision. That is a decision where they have decided to invest a large amount of money for building up their paints business. They were not into the paints business earlier. They were into other businesses, but not into the paints business. So this is one of their capital budgeting decisions where they have decided to compete with the likes of Berger Paints, Asian Paints, Kansai Lambrak, ExxonMobil. These companies are their major competitors, and they have decided to go ahead and make an entry into the paints industry. So now it will depend how they are able to execute, how much market share they are able to capture, and it can impact their growth in the long run. Similarly, automobile company, they decide to invest in electric vehicles, or they decide to invest in hybrid fuels, or biofuels. So what is the basis of our decision making, right? Where do we see the technology going? So it's not easy to suddenly move from petrol and diesel to electric vehicles, but at the same time, if we do not move, then we may fall behind also. So that is the riskiness involved in such kind of projects, but they are also important if we want to survive in the long term, keep up with the technology and keep up with the advancements. So these are important decisions, and they impact the growth in the long run. They affect the risk of the firm. Long-term commitment of funds may also change the risk attribute of the firm. For example, if the investment increases average gain but causes frequent fluctuations in its earnings, the firm will become riskier, and thus the investment decisions shape the basic risk attribute for the firm. Even announcement of a wrong capital budgeting decision can impact the share price significantly. So that means we should look at the strengths of our firms, where we are good at, and accordingly try to expand or diversify. We should not take up such projects which are looking very attractive from the profitability perspective, but involve a lot of risk, or involve that kind of decision making which the company does not have the skill set of. For example, let's say FMCG company suddenly decides to enter into the um, heavy trucks, heavy machinery building, right? So that would be considered very risky from FMCG company's perspective. FMCG is a much more stable, different business than getting into heavy commercial vehicles. So that may look attractive, that there is a lot of profit, there are not enough competitors, etc. But the company should take the decisions, do the decision making, which should not affect the riskiness of the firm too much, because again, large amount of capital is involved, and these are not easily reversible, and hence they can significantly impact the overall riskiness of the firm. So market knows all this. When the company announces any big project which they plan to undertake in future years, the market does its analysis, and accordingly it can have an impact on the share price also. So if any publicly listed company announces that they are venturing into a very risky project which can give huge returns or may result in significant loss, the market will do its own analysis, the market participants, and accordingly they would decide whether to buy or sell the stock, and that can have a significant impact on the share price movement of the publicly listed company as well. They involve commitment of a large amount of fund commitment for the firm for its investment programs is very huge, and it should be planned very carefully, and make an advance arrangement for procuring finances internally or externally. Capital structure should not get distorted. External funds can be arranged by either borrowings from financial institutes. So what we are trying to say here is that there is a large amount of funds which need to be deployed for making such investments or for undertaking such projects, and we need to decide from where we would get the funds. Either it could be through debt funding or through equity funding. Now, debt funding, although relatively cheaper than equity funding, but the problem with debt is that it's a fixed commitment. So we definitely need to pay the interest on time, make principal repayments on time, if we want to service the debt. And that may not be easy if there is an economic downturn and company is not able to generate enough revenues and profits, then it might not be so easy to service the debt. So although cheaper, but if it is large amount of debt, it can increase the riskiness of the firm. It can bring into question the sustainability of the firm in the long run. Other source of fund could be equity. With equity, if we keep on diluting, if we keep on issuing new shares to raise more equity financing, that would also give a negative signal to our existing shareholders. So too much equity or too much of debt borrowing can backfire in the long run. The firm should rely more on internal source of funds, that is the profits, the cash flows they are generating from operations on a day-to-day business, on uh, their core operations, right? So that internal source of funding is usually the most sustainable and the best way to uh, um, rely on funding. So again, it's very important that we take these decisions carefully, because huge amount of funds is involved, and we should not be relying too much on external debt or too much of external equity financing. Irreversibility. When a firm makes a large investment over a project, they are mostly irreversible in nature. It is difficult to find a market for such capital items to pass on once they have been acquired. Sometimes, even if they find someone to buy it, they would acquire it at a discount or scrapped rate. Right? So, as we discussed, let's say a manufacturing company has set up a factory at a remote place, and after 1 or 2 years they find out that it was a wrong decision. Now it is not easy to reverse. They cannot just uh, get back the cost they have incurred um, in setting up the factory. Not only the factory, you would be incurring costs related to land. The company would be incurring a cost related to staff, employees, managers working in that factory. So suddenly deciding to shut down the factory, um, s- um removing all the employees, um, selling off the land and machinery, this is not as easy. And even if you find a buyer, that buyer will definitely exploit the situation and make use of the situation, and um, would be able to purchase it only at a very discounted or a scrapped rate. So this can result in a huge loss for the company if they want to reverse the capital budgeting decision which they have made earlier. Mostly complex decision to make investment decisions are the assessment of future events for the firm, which are difficult to predict. So much uncertainty involved. The estimation of future cash flows depends upon economic, social, political, and technological forces, which causes an uncertainty in estimation. So uh, there is so much in uncertainty involved. Uh, for example, right now we are seeing that uh, AI is making waves, and a lot of technology companies are investing a huge amount of money in building their AI capabilities, um, deploying the use of AI in their day-to-day operations. So now let's imagine a tech company invest a huge amount in AI for 5 years, and then some new technology comes up which can cause a huge disruption suddenly. So it's very complicated. It's not easy to predict the future, especially in the technology space. And similarly, these decisions can be impacted by other factors as well, like uh, political factors. For example, there is a lot of push of ethanol blending in petrol in India. So um, now this is more of a push we are getting from the government, that let's use more and more ethanol and blend it into petrol for our as a fuel. So now uh, a sugar company, let's say, decides to invest a huge amount of money in building ethanol capacity. They set up a plant to specifically for that purpose, and tomorrow the government changes or the policy of the government changes, then it can bring in a lot of uncertainty in terms of what the future will look like. So not easy decisions. Similarly, let's say we have made the decision um, in 2019 or start of January 2020, and suddenly we see that COVID struck. So there is a lot of uncertainty in terms of economic, social, political, and technological forces, which can cause a uncertainty in the estimation. So that's why these are not easy decisions to make. These are very complex decisions to make. So now let's look at types of investment decisions. So what are the different types of projects which a company may decide to undertake? Uh, Different capital projects which would require a huge amount of money and which are not easy to reverse. So there are different types of projects which we are going to look at. First is expansion and diversification. Um, Here, expansion would mean that we are increasing our production capacity. We are already doing something, but maybe at a smaller scale, and we want to expand our scale and do more of what we are doing. That is an expansion project. A firm may expand its activities in a new business. Expansion of a new investment requires investment in new products and a new kind of production activity within the firm. For example, investment in new machine to increase the production for the firm would be an example of an expansion project. For example, let's say a chair manufacturer is making 1,000 chairs in a particular geography, and they see a lot of demand in that geography, and they feel that we can generate more revenues, more profits, because there is a lot of demand for chairs in that geography. So they set up one more factory to produce chairs, and through that factory they are able to expand their operations from 1,000 chairs to 5,000 chairs. So that is a expansion project. Now, when you are doing the expansion project, the decision making we need to do is, would it be profitable or not? uh, would it result in significant economies of scale or not? Would we be able to generate overall more profits or not? uh, is there enough demand or not? It should not impact the price of the product which we are selling, at least not too much, etc., etc. So lot of things need to be accounted for before deciding to go ahead with a expansion project. Similarly, diversification project: when a firm invests in a new product or service which the firm has never delivered earlier, this represents the diversification into new business. For example, in investment in new business for diversification. For example, like we discussed, Aditya Birla Group never entered into the paints industry, but now they are entering into the paints industry through Birla Opus. So, um, would they be able to compete? Would they have any pricing power? Would they get the market share or not? How much marketing selling expense they need to incur to compete with giants like Asian Paints? Uh, Similarly, you see ITC having very diversified businesses. Uh, they are into FMCG, um, paper, cigarettes, hotels. Uh, so they might diversify further into one new domain. Similarly, we see Reliance. Earlier, it was only in um oil and gas, only into the energy business, but they have recently moved into retail, um, telecom businesses. So these are all diversification projects where the company has decided to enter into a new business as well, apart from what they are already doing, which they have never ventured into earlier. So again, before taking these decisions, before entering into a new business area, the firm needs to be very sure about the costs, the benefit which this can result into, the risk involved in entering into these new businesses, the demand for these kind of products or services, and then only they can decide whether to get into the diversification project or not. Replacement projects, modernization projects. So one of the common decision making which the companies need to do is whether to repair and maintain the existing machinery, or replace the old machinery with a new machinery, new technology, right? So when assets become outdated and obsolete with technological changes, firms decide to replace those assets with the new ones. Should we repair and maintain the old assets, or should we buy new machinery? So here the firm needs to decide that what is the technological capability of their existing assets, and are they going to be relevant in future? If not, should we replace them now, or should we repair and maintain them for now and maybe replace them later, right? So how do we deal with the existing fixed assets we have, right? The cost of production will reduce and cost savings will reflect in the increase in the profits, but the firm's revenue may remain unchanged, and buying new assets could be costly, large one-time expense. So that means today we decide to replace all of our old machinery with a new one. That is one thing we can do. Second thing we can do is repair and maintain our existing machinery. Both have the cost involved, and both have their cost and benefits. So that is where the decision making, the analysis of future cash flows comes into, that what would be the right decision at this point of time. Third is mutually exclusive investments. Mutually exclusive means either we can do this project or we can do that project. Okay, either A or B, but we cannot do both. Just one can be undertaken. If one investment is undertaken, others will have to be excluded. For example, a company may either use a more labor-intensive semi-automatic machine or employ a more capital-intensive, highly automatic machine for production. So let's say we are producing mobile phones. Now, should we do it in a more labor-intensive way? That means more of manpower, more employees doing majority of the work, or should we do it in a more capital-intensive way with lot of automated machinery, robots doing the bulk of the manufacturing, and very less of human involvement or manpower required? So we cannot do both. This is a mutually exclusive project. We have to choose which way of production we want to go with, and both will have their cost and benefits. So again, that analysis would be done, that for our firm, which would make more sense in the long term. Usually what the companies do is they start with more of labor intensive, then they move to semi-automatic, and then they move to more of automated way of doing the things. So it could be a gradual transition also, but it has to be clear in terms of either this or that. And accordingly we need to do this decision making. Independent investments, independent projects. These are the investments which serve different purposes and do not compete with each other. Okay, so that means here we are not choosing between A and B. We can do both A and B also, um, if both are profitable. So these investments are not competing with each other. They are independent investments, and we need to look at them in an independent way. Um, for example, a heavy engineering company may be considering expansion of its plant capacity to manufacture additional excavators and addition of new production facilities to manufacture a new product. Light commercial vehicles, depending on their profitability and availability of funds, the company can undertake both investments, right? So here a heavy engineering company may be considering expansion of its plant capacity to manufacture additional excavators. Either they can uh, produce more excavators and addition of new production facilities to manufacture a new product, light commercial vehicles also, right? So uh, excavators and light commercial vehicles, they are not competing with each other. We can make both, given that they should be profitable. So here, these are independent investments, and we will do the cost benefit analysis of both, and maybe if both are profitable, we can go ahead with both. Here we don't have to choose between A and B. We can do both A and B if both are profitable, given we have the capital, because there is limited amount of capital we are dealing with. So if we have enough capital, we can go ahead with both, or we may decide to go with one which is more profitable than the other. Next type of investment decisions is contingent investment. These are the investments which are contingent, which are relying on other thing. These are conditional. These are dependent projects. The choice of one investment necessitates undertaking one or more other investments. For example, if a company decides to build a factory in a remote, backward area, it may have to invest in houses, roads, hospitals, schools, etc., for the employees to attract the workforce. More relevant for capex heavy industries such as metals, mining. So, in general, we have seen a lot of factories being set up in remote areas because the cost of getting the land is less. So, when these heavy capex heavy industries operate, like metals, mining industry, or a steel plant is getting built, or a automobile manufacturing facility is built, if these are happening in remote areas, then um, the company needs to decide how will they get the labor. For attracting the labor there, they might need to make other investments. These are contingent investments that you have to make if you decide to set up a factory in that area. So we might have to invest in roads, hospitals, houses, schools for the employees to attract the workforce. Okay, if there is no infrastructure around that investment in a remote area, then we will not have the labor or the employees able to come up to that investment and contribute there. So we need to make additional investment to uh, uh, to get rewards from our initial large investments. Next, we have characteristics of good capital budgeting decision making. Um, there are certain important points we need to keep in mind when we are doing capital budgeting decision making. Um, all relevant incremental cash flows to determine the true profitability of the project. So, we need to be very careful in terms of which cash flows we are considering to determine the true profitability of the project. We should include all relevant incremental cash flows when deciding whether the project is profitable or not. It should recognize the fact that bigger cash flows are preferable to smaller ones, and early cash flows are preferable to later ones. So this is what we know from time value of money, that $1 today is worth more than $1 1 year later. So if certain returns are coming early, if more returns are coming early, that is more relevant, that is more profitable for us than returns coming later. Because in today's terms, in terms of present value of those benefits get discounted, and they are not worth as much, they are not valuable as much as what we can get sooner. So bigger cash flows, early cash flows are more preferable. It should provide for an objective and unambiguous way of separating good projects from bad projects. So these capital budgeting decisions, these investment decision rules should allow us to very clearly identify which projects are better from the other projects, right? So maybe we are evaluating mutually exclusive projects. So capital budgeting decision should very clearly tell us that which of these two we should go for. Maybe we are evaluating in independent investment decisions. So they should tell us what is the profitability of each project, and whether we should go ahead with one project, first project, second project, both the projects, or none of the projects. So it should be very clearly telling us in deciding between the good projects and bad projects. It should help in the ranking of projects according to their true profitability. So not only whether one project is profitable, but comparison of projects. Let's say we have 5 projects we can do. So which is the best one to undertake? What should be our priority 1? What should be priority 2, priority 3, priority 4, priority 5? So it should help us in ranking of projects, so that we can decide based on the capital which project should we undertake out of those 5. It should help to choose among mutually exclusive projects with the objective of maximizing the shareholders' wealth. It should be a criteria which is applicable to any conceivable investment projects independent of others. So again, the idea we are working is that we want to maximize the shareholders' wealth. That is the objective with which we are undertaking these projects, that we should be able to generate more returns than the cost of our capital, than what the capital providers expect us to earn. We should do projects which are earning that much or maybe more than that, and that is how we can maximize the shareholders' wealth, maximize the value of the firm. Yeah. Now, what are relevant cash flows? There are different types of cash flows which would be incurred during the project, during the life of the project, but which cash flows should we consider and which we should not consider? Ideally, we should not use accounting profit. So in majority of the cases, we do not use accounting profit. That is more of a book entry. We cannot say that your returns are your accounting profits, right? So this could be very different from what cash we are able to generate. Rather, we should take incremental cash flows, those cash flows which are occurring due to the project. Secondly, old machine could be sold, will now be used in new projects. So that means, um, yeah, let's look at this scenario, that old machine, that there is a company which has one machinery which is sitting idle. Yeah, uh, the company is doing a lot of work, using a lot of machinery, but one machine of the company is not being used. It is sitting idle, and it could be sold for $1,000. Okay, but as of now it is sitting with the company. The company has not sold it, but the company can sell it for $1,000, right? So now let's assume that company is taking up a new project, doing a new project. Should they consider any cash flows related to that machinery? That machinery, old machine, which was sitting idle, which could be sold for $1,000, will now be used in that new project. So in that case, should we involve any cash flows related to that machinery when we are evaluating the new project? We should, because had we not done this new project, then we could have sold the old machinery for $1,000. Now, because we are doing this new project, that is why we will now not sell the machinery for $1,000. So we could have got a cash inflow of $1,000 had we not done this project. But now, because we are doing this project, we will not be able to generate this $1,000. So while evaluating this project, we should do minus 1,000. We should show it as a cash outflow. Yeah, that this is a cash flow which got impacted due to the project. So this should be included while evaluating the project. Let's look at one more scenario. There are some permanent employees which are sitting idle in the company as of now. They do not have the work as of now, but they are permanent employees. They need to be paid a particular salary, and they are getting paid regularly, but they are sitting idle. Now a new project comes up for the company in which these employees would be deployed. So should we include the cost of these employees for that new project? Ideally, no, because they were already getting paid, right? They were already getting paid, and they will continue to get paid. So when we are evaluating this new project, it is not a cash flow which is impacted due to the new project. They were anyways getting paid earlier, and now also they will get paid. So that is not impacting the cash flows. This project is not impacting those cash flows related to the salary of those employees. So it's not an incremental cash flow, and hence we should not consider it. Next scenario, cannibalization, loss of sale of other product because of new product. So let's consider this as an example that company has launched a new product which is impacting the sales of other product, right? So it is similar product, not exactly the same product, but it is in the similar space, and that launch of new product has impacted the sale of the existing product of the company. So now we should consider the lost sales of the old product while we are evaluating the new product. One more scenario, consultancy fees paid for research about the demand of the product. So let's say before doing any project, we want to be very sure about the demand of the product. Is the product going to sell in the market or not? should we go ahead with this product or not. So before taking the decision to invest in this product, launch this product, we want to do a research. So we hired a consultancy firm. We hired a consulting agency to help us in doing this research, that what is the demand of the product, how much is the demand, uh, what is the price point at which we can sell this product, to whom, where do we need to sell it, to whom can we sell it, what is the expected revenue, what is the expected cost and profit which we can expect from this product if we go ahead with this product. So we are doing all that research work. There is a consulting firm we have hired which is doing all this research work for us, and based on their research, based on their findings, we will decide whether we want to go ahead with the project or not. So the fees the consulting firm is going to charge us to do that research, to present a report to us about the new product, the fees they are going to charge, that is a sunk cost. Sunk cost means that is a cost which is gone, that we cannot recover, whether we want to go ahead with the project or not, right? So after the report the consulting firms provides us, we will decide whether to go ahead with the project or not. But um, that cost is already incurred, that fees is already paid, whether we go ahead with the project or not. So we should not consider that cost while doing the evaluation of the project, because that is a sunk cost. That is not a cost which is due to the undertaking of that project, right? And we will undertake the project later, but that is a cost which is already gone. So that is a sunk cost, and we should not be considering the sunk cost in our decision making. So now we are looking at different evaluation criteria or different techniques to do capital budgeting. Okay, so we are looking at evaluation criteria for capital budgeting techniques, may be grouped into two following categories. One is discounted cash flow DCF criteria. Other is non-discounted cash flow criteria. So broadly, the capital budgeting techniques can be divided into two categories. One category which uses discounted cash flows, and the other category which uses non-discounted cash flows. Now, discounted cash flows means we are going to consider the time value of money. That means we are not going to value the cash flow which is coming in 1 year with the same value the cash flow which is coming after 5 years, right? So because the time value of money concept says that the money we are receiving early has a higher value. $1 we are receiving in 1 year has a higher value than $1 we are receiving after 5 years, because that $1 we are receiving after 1 year, we can invest it for 4 years and make it much more than $1 after 5 years. So it is not the same as getting $1 after 5 years. So this is why time value of money is a very, very important concept in doing any decision making in finance, including capital budgeting decision making also. We should ideally consider the time value of money. So DCF criteria, DCF techniques are more logical, more preferable, more widely used than non-discounted cash flow techniques, which do not consider time value of money. So they are ignoring a very important aspect of time value of money, which is not how we should go about it, but they have certain aspects to them which are useful. So that is where we use them. But broadly, for any logical decision making, we rely on DCF techniques. Now, within the DCF evaluation techniques, we will be looking at net present value technique, NPV technique, IRR, modified IRR, and profitability index. So these are all the techniques which take discounting of cash flows, which take time value of money into consideration. Then we have non-discounted cash flow evaluation techniques, which do not consider the time value of money, such as payback period and accounting rate of return. They have certain advantages which we can use them for, but they cannot be solely relied upon for eventual decision making. Let's talk about the very first technique we have, which is the net present value. So this is a discounted cash flow criteria. That means it considers the time value of money, and this is probably the most widely used, the most popular capital budgeting technique, which is used across the industry. It is the net present value of all the cash flows that occur during the lifespan of the project. It is the net present value of all the cash flows that occur. That means there would be some cash inflows which are occurring, there would be some cash outflows which are occurring. So first we consider the present value of all those cash flows, and then we net it off. So cash inflows, present value of all the cash inflows minus present value of all the cash outflows will give us the net present value. So it is the net present value of all the cash flows that occur during the lifespan of the project. The outflows will have negative values and inflows will have positive values. So the outflows will have negative values and inflows will have positive values. Means how do we show them? While doing the calculations, we show all the outflows as minus, as negative value, and all the inflows as positive values. For example, if we are setting up a factory, and that would mean investing $10 lakh, so that $10 lakh is a cash outflow. That cash is going out from the company to set up that factory, so that will be shown as negative. That is a cash outflow, that will be shown as negative. And all the cash inflows, the cash flows we are going to generate by utilizing the assets in the factory, those cash flows we are receiving, so those are inflows, and we will show them as positive value in our Excel sheet when we are doing the calculations. If present value of inflows is greater than outflows, we get a positive NPV. So what is NPV? Present value of cash inflows minus present value of cash outflows, or the present value of all the cash flows. That is NPV. So if present value of cash inflows is greater than present value of cash outflows, we obviously will get a positive NPV. That means this project, this investment is giving us a positive NPV, which means that the value we are getting in today's term is more than value or the investment we are doing in today's term. So that means overall net off, it is giving us a positive value, right? So it is a good investment decision if we go ahead with it, if it is giving a positive NPV. Any project which gives a positive NPV is acceptable. If it gives a negative NPV, then project should not be accepted. So what is the decision rule when we are using the NPV technique is that any project, once any investment which we have evaluated using NPV technique, if the NPV is coming out to be positive, that means it is a profitable project, profitable investment, and we can go ahead with it. It is acceptable. If it is giving a negative NPV means present value of cash inflows is less than the present value of cash outflows. So what we are investing, what is going out in today's term is more than what is coming in today's term. So why should we do that project? Um, Investment is higher than the returns we are getting. So that would result in a negative NPV. And as per the decision rule, if the NPV is in negative minus, we should not accept that project. We are losing the value in that case. We are wasting our money in that case. Um, NPV method is scientific and appropriate, considers time value of money. So because it considers time value of money, it is considered to be scientific and appropriate, logical. It is very important that we consider time value of money. That could be considered as a good technique, and we can rely on that technique for decision making. Limitation is it gives an absolute value. So comparison between two projects of different sizes is not easy, right? So what we are saying here is that NPV will come out as an absolute value. For example, NPV is 10,000. Now it is not telling us anything related to the size of the project. It is not considering the size of the project. A small project can also give 10,000 as the NPV. A larger project can also give 10,000 as the NPV. In that case, which project should we choose? Yeah, just by looking at the NPV value, just by looking at 10,000, we cannot make that decision that we should go for this project or that project, right? Because it is just giving us an absolute value. So just looking at that absolute value, we will not be able to decide between the two projects. It is not considering the size of the project. It is just considering the size of the cash flows, which are the net present value of the cash flows it is considering. And it is not going to help us in terms of ranking the projects or comparison of projects of different sizes. Okay, let's look at an example to understand the NPV technique better. Okay, let's read the example. Let's assume we can have the opportunity to start to do a franchisee business for 5 years. So we can set up a franchisee business for next 5 years. That franchisee business would require initial investment of $1.2 million and is expected to generate 3 lakh as returns in the first year, which would grow by 10% every year and also return $2,000, $2 lakh as salvage value after 5 years. Okay, so starting that franchisee business, the initial investment is expected to be around $1.2 million and is expected to generate $3 lakh as returns in the first year. So once we have set up that franchisee business by investing $1.2 million in the first year of its operations, it is expected to generate $3 lakh as returns, which would grow by 10% every year and also return $2 lakh as salvage value after 5 years. So those $3 lakh which we are generating in the first year would grow by 10% every year. So next year it would be 3,30,000, and so on. It will grow by 10 year every year, and also $2 lakh as salvage value after 5 years. So after 5 years, we will also get back $2 lakh as a salvage value. Alternatively, we could invest that money in equity markets with an expected annual return of 14%. So either we can do this business, set up this franchisee business and invest our $1.2 million in that for that franchisee business, or the other option we have is that we could invest that money in equity markets with an expected annual return of 14%. So that means this is the second option we have, that we could invest that money in equity markets, stock markets, and generate 14% return. So we have limited capital, let's say $1.2 million, and either we can invest it in equity markets and with an expected annual return of 14%, or we can set up this franchisee business, right? So we view the franchisee business opportunity and investment in equity markets as comparable investment risk opportunities. So what we are saying here is that we are considering both to be equally risky. Okay, so whether we go ahead with the franchisee business or we invest the money in equity markets, we are considering it to be having the same uncertainty, same risk involved. So we can evaluate them as two opportunities with equal amount of risk. So that 14% could be considered as our opportunity cost. If we go ahead with the franchisee business, that 14% is what we are not going to get as our expected return by investing in equity markets. So if we are doing the franchisee business, that means we are not going to be able to make the investment in equity markets. That means we are expecting to lose out on that 14% annual return which we could have made. So that 14% should be our discount rate while discounting the cash flows. That is our opportunity cost. Okay, opportunity cost of doing this business, of doing this franchisee business, is 14%. We are losing out on that 14% which we could have made through equity market investments. So this is our opportunity cost. And what are the cash flows related to this business? So how we put the cash flows is we make a small table in which we are mentioning the periods as 0, 1, 2, 3, 4, 5. 0 means now, present. So let's say we are evaluating from today's perspective. If today we invest $1.2 million, if today we invest $1.2 million, because we are investing, that's why we are showing it as minus. It's a cash outflow. The cash is going out from the company. So this cash outflows are represented as negative value. And what we are going to get is 3 lakhs as the returns in first year. So this is a cash inflow. So we will show it as positive. All these remaining are our cash inflows. So we will show them as positive values. In the first year, it is 3 lakh, which would grow by 10% every year. So next year cash flows would be last year's value grown by 10%. So this will keep on happening, and also return $2 lakh as salvage value after 5 years. So my 5th year cash flow would be this plus $2 lakh. Okay, so all these are cash inflows. So we are showing them as positive values. These are the benefits we are getting, but we are getting them later, after 1 year, after 2 years, after 3 years, after 4 years, after 5 years. So but this cash investment of $1.2 million is going out today. Okay, so we cannot directly compare these numbers because these are happening at different time periods. We need to bring them all to a present value perspective. That means we need to bring them their value to in today's terms. So what is the present value of those cash flows? So this is the cash flow, and to calculate the present value, we will use this discount rate. So this is the present value of cash flows. What does it mean? That 3 lakh which we are receiving after 1 year is worth only this much in today's terms. Okay, in today's terms, this 3 lakh is worth only this much. This 330 which we are getting after 2 years, in today's terms, it is worth only this much. Similarly, the future cash flows which we are getting later, what is their present value? This is their present value. Okay. Other way of finding out the present value is through discount value factor, in which basically what we do is so these are the discount value factors. That means what is the value of one unit, $1 in today's terms. Okay, so $1 after 5 years is worth only 0.519 today. $1 after 4 years is worth only $0.592 today. So this is the discount value factor. This is the value of $1 in today's terms. Okay, the $1 we are going to receive after 2 years, in today's terms, its value is only $0.769. So this is the discount value factor, and then we can multiply the discount value factors with the actual cash flows. This will also give the present value of those cash flows. So if you see, this and this should match. Yeah, these are matching. So these are two different ways to calculate the PV of cash flows. One is directly discounting the future cash flows using the discount rate of 14%, multiplying raised to the power the number of periods later it is happening, or calculating the discount value factor first and then multiplying the discount value factor with the cash flows. And the NPV would be the sum of all the present values, inflows and outflows. The sum of that would give us the net present value. The net present value in this case is $1,30,510. So that means the NPV is positive. That means the PV of cash inflows, it means PV of cash inflows is greater than PV of cash outflows. That means overall the value of the firm will increase by this much if the company decides to take up this project. Or let's say an entrepreneur is taking up this project and not investing in equity markets. The other option, if you remember, was we could invest and that money in equity markets with an expected annual return of 14%. So that means the entrepreneur which has decided to let go of that 14% would be in benefit by going for that franchisee business rather than investing in equity markets, because equity markets, the expected return was 14%, but here in this franchisee business, even after discounting the cash flows by 14%, we are still getting a positive NPV, right? So even after considering that discount rate, that opportunity cost, we are still, our PV of cash inflows is higher than PV of cash flows. That means definitely we are getting a return of more than 14% by doing this franchisee business. And because these, both the alternatives were considered to be of comparable risk, some similar risk opportunities, Hence, if the risk is same, then we should go with the higher returns which franchisee business is giving us rather than the investment in equity markets. So NPV positive means we should go ahead with this project. So what is the selection or decision making criteria using the NPV technique? If NPV is above 0, then we may accept the investment proposal. If NPV is below 0, then we must reject the investment proposal. If NPV is equal to 0, then we may or may not accept it. Okay, so because there is uncertainty, that's why we are using the discount rate. Discount rate is reflecting that uncertainty, that risk involved with making the investment, and based on that discount rate, if NPV is still coming out to be positive even after considering the discount rate, then we must accept the investment proposal. If it is below 0, that means we are not getting the returns as much as we want because of that discount rate, then we must reject the investment proposal. And if it is 0, then it is up to the decision maker. Do they have other projects which have positive NPV, or this is the best choice they have, best decision they have, then they can go ahead with that. But we should definitely not go with a project which has a negative NPV. So the decision rule is accept it if NPV is greater than 0, reject if NPV is less than 0, may or may not accept if NPV is equal to 0. Let's look at next example for NPV again. The investment in a project is $8 lakh. Cost of capital is 10% per annum. The cash flows after taxes are expected to be as under. Find out whether the project is worthwhile. Okay. So again, we are looking at a project. The company needs to decide whether they should go ahead with the project or not. All the relevant values are given to us. Investment in a project is 8 lakh rupees. So that means this is our outflow, cash outflow. And let's assume it is happening today. So if we are investing 8 lakh rupees today, so we will show it under 0 as minus 8 lakhs, and cash flows are expected. So after 1 year, we will get 1,50,000. After 2 years, 220, and so on. These are the benefits. These are the inflows we will get by doing this project, and we are looking for at least a return of 10%. Our cost of capital itself is 10%. So definitely we are looking for at least 10% returns. So our discount rate would be 10% in that case. So let's look at the workings. So let's look at how we will discount these cash flows to calculate the NPV. So the initial investment of 8 lakh rupees is shown as minus, that is a cash outflow, so that's why we are showing it with a negative sign, and we are assuming that that investment we are making today, now, at present, so that's why it is shown against 0. And these are the expected future cash flows which are coming in at the end of different periods. So accordingly, we can do the calculation to figure out what is the NPV, whether we should do this project or not. What is the return? Minimum return we are expecting is 10%. Okay, so let's do this. The investment in the project is 8 lakhs. So we will do minus 8 lakhs and the expected cash flows are 150 after 1 year, 220, 270, 290 and 210. So this is how our cash flow table looks like. 0 means now present, cash flows, outflows are shown as negative values, cash inflows are shown as positive values. So this is our cash flow table. Our required rate of return is 10%, also known as cost of capital or opportunity cost adjusted for risk involved in the project, that is 10%. And now we need to find out the NPV of the project. So we can calculate the PV of all the cash flows like this, or we can find out the discount value factor. And find out the PV of cash flows by multiplying the discount value factor with the actual cash flows. So the NPV is coming out to be 49,504. So that means NPV is greater than 0. So that means we can do this project. This project is giving us a return of more than 10%, and that is why NPV is coming out to be positive. So next capital budgeting technique we are going to discuss now is IRR, which is internal rate of return. Okay. This is also one of the discounted cash flow criterias, which takes into account the time value of money, and again one of the widely used popular techniques for doing capital budgeting. Internal rate of return is a metric used in financial analysis to estimate the profitability of potential investments. IRR is a discount rate that makes the net present value of all the cash flows equal to 0 in discounted cash flow analysis. So we learned about NPV technique, which was giving us a absolute value, the net value added, value addition we have done. If we undertake that project, that is reflected by NPV. It gives us a absolute value number, whereas IRR is telling us the profitability of potential investments in terms of percentage. So IRR could be 15%, 16%, 17%. So it is a percentage value which is giving us what is the actual rate of return we are getting from the project if we undertake this project. So it is not an absolute value. Unlike IRR, it is not an absolute value. It is a percentage which tells us what is the, if these cash flows turn out to be true, what is the actual rate of return we are going to get from the project. And if we look at from the discount rate perspective, if we use that IRR value as a discount rate and discount all of our cash inflows and outflows, the NPV using IRR as the discount rate, if we calculate the NPV, it will come out to be 0. Okay, so that means the discount rate at which the NPV comes out to be 0 is the IRR, is the internal rate of return. Let's understand it better through some workings. Okay. Let's look at this example to understand IRR. John wants to decide whether to go ahead with a savings plan or not. Saving plan requires an investment of $10,000 at the beginning. Proposed in benefits would be received from end of year 2 of making the investment, amounting to $3,500 for next 4 years starting from end of year 2. John wants to evaluate what is the effective annual rate of return which this saving plans is providing. He is not fine investing in any plan which returns less than 8% annually. Okay, so in our usual life, we come across situations where we are presented with a investment plan, right? So how do we decide whether we should go ahead with that investment plan or not? This is the same situation which John is facing. The investment plan presented to John is requires an initial investment of 10,000. So 10,000 is expected to go out today if John decides to go ahead with this plan, and if John makes this investment, he would receive the benefit of 3,500 starting from year 2 for next 4 years. John wants to evaluate what is the effective annual rate of return which this saving plan is providing. John wants to know what is the return he is getting from if he makes this investment. There is no percentage here. There are absolute values, if we can see, minus 10,000 at the beginning and 3,500 for 4 years starting from end of year 2. So these are absolute values which we are looking at. But what John wants to know is what is the effective annual rate of return? What is the percentage return which he will get from this plan if he goes ahead with this plan? He is not fine investing in any plan which returns less than 8% annually. So John doesn't want to invest in any plan which is giving less than 8%. Maybe he has some other option in which he can easily earn 8% returns. So he's not looking for anything which provides him less than 8%. So what he wants to know is what is the return this plan is giving. If the return is more than 8%, he will go ahead with this plan. If it is less than 8%, he will not go ahead with this plan. So what is the internal rate of return? What is the actual return which the John will get if these cash flows turn out to be true? So let's figure that out. Discount rate we are taking at 8%. Because he wants at least 8% returns. So let's take the discount rate as 8%. In that scenario, first let's calculate the NPV, then we'll move on to the IRR part. Discount value factor is 1 divided by 1 plus discount rate raised to the number of periods. So NPV is coming out to be 733, right? Okay, so NPV is positive. That means we are getting a return of more than 8%. That is why NPV is coming out to be positive. Now, NPV value positive means if these cash flows turn out to be true, then our rate of return from this project, from this savings plan, is more than 8%. Okay, this is the meaning of positive NPV. But is it telling us what is the let's say annual rate of return we are getting? No, NPV doesn't tell us that. NPV is giving us an absolute number. What we are looking for is a percentage. What is the annual rate of return we are getting? That will be told by IRR. And IRR is also the discount rate. IRR is the discount rate at which NPV becomes 0. Right? So let's try that. Let's change the discount rate and see where the NPV is becoming 0. So what I'm going to do here is I'll change the discount rate and accordingly see. Okay. Yeah, so I'll change this figure and accordingly see what is the impact on NPV. So let's focus on these two. If I increase this discount rate, NPV will go down. Yeah, because my discounting is happening if more than at 8%, if it is happening at 9%, 10%, then net present value of will go down. So we can see that. Let's make it 9%. Net present value is now only 402. So it is still positive. That means these cash flows are giving me a return of more than 9%. Let's make it 10%. It is now coming out to be 85 only. So still it is positive, means these cash flows are giving me a return of more than 10%. Let's make it 10.2%. If we make it 10.2%, then NPV is 24. So what we are doing is more of hit and trial. Yeah. So now it is negative. So that means it is somewhere in between 10.2 and 10.5. Let's do 10.3. It is almost 0. 10.4. Yeah. So 10.3 is minus 6. 10.2 was positive. 10.3 is negative. So IRR is somewhere between 10.2 and 10.3. Yeah. So we can do this hit and trial to find out what is the discount rate at which NPV becomes 0. Or there is a direct formula in Excel. We can simply use the IRR function and give it all the cash flows, and it will tell us exactly the discount rate at which the NPV becomes 0. Okay, so this is the discount rate. We figured it out by hit and trial that it is somewhere between 10.2 and 10.3. Exactly, the IRR function can be used to find out that discount rate at which the NPV becomes 0. So it is becoming 0 at 10.28%. So this is our internal rate of return. This is representing the annual rate of return we are getting from this saving plan if the expected cash flows turn out to be true. This is representing the annual rate of return we are getting from the savings plan if the expected cash flows turn out to be true is 10.28, right? So this is the return John would get, and he wanted more than 8% annually, and he's getting 10.28. So this is definitely a saving plan which John can go ahead with. I hope we are clear with what is the meaning of IRR. So IRR is the discount rate at which NPV becomes zero. If we increase the discount rate, NPV starts going down, and the discount rate at which NPV becomes zero is known as the IRR. Thus, IRR is estimated to be 12.23%. This is the return that is the forecast for the project. What is the decision criteria? We compare IRR with our required rate of return. IRR is the actual rate of return we are getting from the project. We compare it with the required rate of return. If IRR is greater than our required rate of return, we should go ahead with the project. Otherwise, we should not go ahead with the project. If the target return, in this case, let's say IRR of a project is this much. If the target return was 9%, then the project would be accepted. Our required rate of return was only 9%, but this project is giving us 12.23%. In that case, the project should be accepted. If the target return was 17%, but this project is giving us 12.23%, then the project should be rejected. So what we do in case of NPV, our decision criteria was if NPV is positive, we are going ahead with the project. Whereas in this case, we are comparing the IRR, which is a percentage value, with our required rate of return. If IRR is more than required rate of return, we are going ahead with the project. Otherwise, we are not. Few more points related to IRR. It considers the time value of money, which we have seen. We are discounting the cash flows. So definitely it is considering the time value of money. Acceptance rule is we compare it with the required rate of return. If IRR is greater than the required rate of return, we accept the project. Otherwise, we do not. It measures profitability. It considers all cash flows occurring over the entire life of the project to calculate its rate of return. So it does not ignore any cash flows. It considers all the cash flows right from period 0 till the end of the project. And it is consistent with the objective of shareholders' wealth maximization. Now let's talk about some limitations. Okay. One significant drawback is that IRR assumes that interim cash flows are reinvested at the calculated IRR, which may not be a practical assumption. Okay, we will discuss these limitations in detail. Let's read it out first. IRR does not handle non-conventional cash flows well, such as changing signs negative to back to positive. Non-conventional cash flows projects may have multiple more than one IRR, creating confusion. So two broad limitations of IRR is it does not handle non-conventional cash flows well. Non-conventional cash flows means those cash flows which change sign more than once. So minus, plus, then again minus, something like that, right? So which are where the sign is changing more than once. That is a non-conventional cash flow. And if there are such non-conventional cash flows and we apply the IRR function, it may not result in any value, or it may give more than one IRR. There may be more than one discount rate, which makes the NPV of those non-conventional cash flows 0. Second drawback is that it assumes that all the interim cash flows will be reinvested at the calculated IRR, which may not be a practical assumption. For example, let's understand the limitations of IRR again through an example. Here, We are setting up a new production line for an automobile manufacturer, which will cost around 5 lakh for the company. That production line is expected to be used for 3 years, post which it will be scrapped with a salvage value of $2 lakh. Expected interim cash flows are as follows. Calculate the IRR by this new production line. Right? So let's quickly look at the cash flows. Initial investment, setting up the new production line will cost 5 lakh for the company. So this is a cash outflow. We will show it as a negative value, and we are assuming this cash flow is going out in the present today. So minus 5 lakh will be the cash flow under period 0. That production line is expected to be used for 3 years, post which it will be scrapped with a salvage value. So what are the benefits we are going from that? We are getting from that production line is 150 at the end of year 1, 250 at the end of year 2, and 2 lakh plus salvage value, which is again 2 lakh. So 4 lakh at the end of year 3. Okay. So these are the projected cash flows for this project. And if we look at IRR of this project, it is coming out to be 23.24%. So we have calculated the IRR provided by this new production line. That means this is the return this production line will give us. Okay, this is what we know of IRR. But what is the assumption? What is the limitation here? IRR assumes that cash flows are reinvested at the calculated IRR, which may not be a practical assumption. That means this return we are going to get, the assumption here is that the interim cash flows, this 150 we are getting at the end of year 1, this 250 we are getting at the end of year 2. These are known as interim cash flows. These interim cash flows will be reinvested at the same rate as IRR. That means the assumption here is that we will reinvest this 150 for 2 years at the same rate of IRR. We will reinvest this 250 for 1 year at the same rate of IRR. If we do not do that, then our actual rate of return will not be 23.24. If we do not reinvest these cash flows, our actual rate of return will be much lower than 23.24. Okay, so this figure of 23.24 we are getting is inherently assuming that we will reinvest these interim cash flows at the same rate. Now, is it practical to assume that we can reinvest the interim cash flows for this much period at the same rate? 23% is a high percentage. We may not have opportunities available at this time. At the end of year 1, we may not have the opportunities available to reinvest this $1,50,000 at 23%. Similarly, at the end of year 2, we may not be able to reinvest this $2,50,000 at the rate of 23%. So that means this is not practical to assume that this will definitely happen. But this is the assumption of IRR. This is what IRR assumes, and that is why we say it is a limitation. Here in this case, IRR of 23.24% of the project is implicitly assuming that all interim cash flows would be reinvested at the same rate of 23.24%, which is not practical. Okay, let me show you how it is assuming this. Okay, if this is reinvested at 23.24%, what I'm doing here is that, just a second. So what I'm doing here is I'm saying if this cash flow is reinvested for 2 years, that means till the end of year 3. If this cash flow which we are receiving at the end of year 1 is reinvested for 2 years at 23.24%, what will be the future value? Let's assume this is reinvested for 2 years. So this should become this much. Okay. So that's what we are assuming, that this cash flow would become this much if it is reinvested at 23.24% for 2 years. Similarly, this cash flow, let me give it a slightly different color. This cash flow, if this cash flow is reinvested for 1 year at 23.24%, what will it become? This will become this much. And this one is already the same. This will stay the same. So this is 4 lakh. So we invested 5 lakhs at the beginning and got some cash flows, reinvested that cash flows, and this is the final value we are getting at the end of year 3. Okay, here we are assuming that all the interim cash flows are reinvested at this rate of 23, which is IRR. So this is the future value of all the cash flows we are getting. So what is the return we are getting? Let's look at the rate of return we are getting. Number of periods is 3, PMT is 0, present value is this much, and future value is this much. Yeah, so you can see that the return we are getting from the project is 23.24. So it is internally, this is the return you are going to get because of the internal assumption that all the interim cash flows would be reinvested at this rate. Now let's try to change the reinvestment rate. What I am saying is that we will not be able to reinvest these interim cash flows at 23%. We will be able to reinvest these interim cash flows maybe at 10%. If that is the case, our returns become 19.65%, and now it is not 23.24%. Okay, so this will be only 23.24% if we are assuming that all the interim cash flows are reinvested at the same rate of IRR, which may not be practically possible. This is limitation 1 of IRR. Now, coming to limitation 2 of IRR, second limitation of IRR is it does not handle the non-conventional cash flows well, such as changing signs negative to positive and back. In such cases, non-conventional cash flow projects may have more than one IRR, creating confusion. So, let's look at these cash flows. Let's say a project has these cash flows where it is changing sign more than once. So first it is negative, then these cash flows become positive, then again it becomes negative. So it is changing sign more than once, minus to plus, and then again from plus to minus. This is what we call as non-conventional cash flows. So in such cases, there could be more than one discount rate which is giving a NPV of 0. Okay. So for example, let's say first IRR we are getting is 9.9%, and if we find out the using this discount rate, if we find out the NPV, it is coming out to be 0. Okay, so NPV is coming out to be 0 with this discount rate. So this is one IRR, and we can look at this is one more discount rate. If I use the calculations here, if I find out the NPV using this discount rate now, then again it is coming out to be 0. So that means there are two discount rates. There are two discount rates at which the NPV is coming out to be 0. This is an example of that project which has non-conventional cash flows, and when we are finding out the IRR of this project, we are getting two IRRs. So now how do we decide? Should we go ahead with the project or not? Let's say our required rate of return is 15%. So one IRR is less than 15%, which is saying, no, we should not go with this project. And one IRR is more than 15%, which is saying that we should go ahead with this project. So in that case, we cannot decide. It is creating a confusion for us. Right? So this is the problem. This is the limitation IRR technique has, where it may give more than one IRR, more than one discount rate, where the NPV becomes 0. So it is not useful in handling non-conventional cash flows because it may give multiple IRRs. So these are the two limitations of IRR technique. Let's quickly revisit the summary. One significant drawback is that IRR assumes that cash flows are reinvested at the calculated IRR, which may not be a practical assumption. Secondly, it doesn't handle non-conventional cash flows well. In case of non-conventional cash flows, project may have more than one IRR, creating confusion. So this is what we saw, and that is why IRR is not as useful or as popular as NPV technique, but still it has its advantage in the terms of that it gives a percentage value, whereas NPV was giving an absolute value. So from that perspective, we should use IRR, but it is not useful in case of unconventional cash flows. Okay, so let's look at some examples of NPV and IRR technique. First one is, given the following cash flows for a capital project, calculate the NPV and IRR. The required rate of return here is 8%. So we are provided with some cash flows, cash outflows, and then cash inflows. For these cash flows, we want to find out what is the required rate. The required rate of return is given to us 8%. We want to find out the NPV and IRR for this capital project. So let's do this on Excel. What are the cash flows? Minus 50,000, 15,000, 15,000, 20, 10 and 5. Okay, so these are the cash flows, and we want to find out the NPV and IRR. So let's do this. Discount rate given to us is required rate of return is 8%. Present value of cash flows can be calculated as cash flow divided by the discount rate raised to the power duration period. This can also be calculated through discount value factors. And we can multiply the discount value factors with cash flows. So the NPV of the project is 3,378.8, and let's calculate the IRR also. IRR is the discount rate at which the NPV becomes 0, and IRR can be calculated on Excel using the IRR function of Excel, where we provide all the cash flows. So IRR is 11%. To be very precise, it is 10.88%. So this is the discount rate at which the NPV will become 0, or this can also be called as the internal rate of return or the actual rate of return provided by the project if these cash flows turn out to be true. Let's look at next example where it is also related to both NPV and IRR, and we are reviewing a profitable investment project that has a conventional cash flow pattern. By conventional cash flow pattern, we mean those cash flows which are changing sign just once. If the cash flows for the project initial outlay and future after tax cash flows all double, the IRR would. So we are not provided with any values here. The question is, if the cash flows for the project initial outlay and future after tax cash flows all double, what would be the impact on IRR and NPV? So that means let's take an example here. If the cash flows for the project initial outlay and future after tax cash flows all double. So let's assume some values, and then we will be able to double those values and see what is happening. So So let's assume these cash flows. Initial outlay is $1,000 and the inflows is $400 for 5 years. And let's figure out what would be the IRR for this project. So IRR of this project is 28.65, and let's figure out the NPV. We'll just assume some discount rate. Let's assume it to be 10% and figure out what is the NPV of these cash flows. So NPV is 516.3. Let's note it down. And IRR is 28.65. Okay. So this is what we are getting with these cash flows. NPV of 516.3 and IRR of 28.65%. Now what we'll do, as the questions ask for, if everything doubles, the cash flows double, then what will be the impact on NPV and IRR? So let's make it minus 2000 here and make these cash flows as 800. Now what is the impact? We see NPV has doubled, but IRR remains the same. Yeah. So if all the cash flows, initial outlay and after tax cash flows double, if all these cash flows double, the NPV doubles, but the IRR remains the same. Let's look at one more question. Here we are given with two projects which have similar outlays. We can see from the table it is minus 50 for both. Although pattern of future cash flows are different, the cash flows as well as the NPV and IRR are shown below. For both the projects, the required rate of return is 10%. Comment on how the company should decide to invest. So here we need to figure out in which project should the company invest, or it can be both. So if we look at the decision making criteria for NPV, it says that if NPV is positive, we should go ahead with the project. In this case, NPV for both the projects is positive. For project 1 it is 13.40 and for project 2 it is 18.30. So that means both the projects have a positive NPV. So as per the NPV decision making criteria, both are good to go ahead. Now let's look at IRR. The required rate of return is 10% and both the projects are also generating a return of more than 10%. So as per the IRR decision making criteria as well, if IRR is greater than the required rate of return, we should go ahead with the projects. So in this case, what we can say is that if the company has the capital to invest in both the projects, they can take up both the projects. But in case they want to take up one only, then we can suggest that they should go for project 2 because that has a higher NPV. That means the increase in the value of the firm would be 18.30 as compared to project 1, which is only giving a NPV of 13.4. So by investing 50, we are getting more value from project 2. Net present value is higher, 18.30, and the objective with which we work is maximizing the value of the firm, the shareholders' wealth. So from that perspective, project 2 will increase the value of the firm by 18.3%, 18.3 versus project 1, which is only increasing the value of the firm by 13.4%, 13.40. So from that perspective, from the amount of NPV generated perspective, project 2 is better than project 1. Okay, let's look at one more question. How many discount rates produce a 0 NPV for this project? Okay, so let's look at the cash flows for this project. -50, 100, 0 and -50. So it is a non-conventional cash flow pattern where the sign is getting changed more than once. In this case, we have seen that there can be multiple discount rates which give you an NPV of 0. So let's figure out. Options are one discount rate, which is 0%, two discount rates, 0 and 32%, two discount rates, 0 and 62%. So basically 0%, 32% and 62%. Which of these discount rates give a NPV of 0? So let's do it. Cash flows are -50 plus 100, 0, -50. Now, which discount rate will give us a NPV of 0? If the discount rate is 32%, let's try with 32%. What is the NPV we are getting? So NPV is coming out to be 4. So discount rate of 32% is not giving us a NPV of 0. Okay, so let's look at discount rate of 0. Yes, discount rate of 0 is giving a NPV of 0. And let's try with 62%. Discount rate 62% is also giving a NPV of 0. So that means there are two discount rates, 0% and 62%, which are giving us a NPV of 0. So now let's look at one more concept, which is modified IRR. We saw that IRR has two limitations. One significant drawback is that IRR assumes that cash flows are reinvested at the calculated IRR, which may not be a practical assumption. So the problem with IRR was that it assumes that all the interim cash flows will be reinvested at the same rate of IRR, which may not be practical. And this limitation is overcome by modified IRR, MIRR, which is a financial metric used to evaluate an investment or project by considering both the reinvestment and financing of cash flows. It is used to address the limitations of IRR, especially the reinvestment assumption. MIRR provides a more realistic perspective by assuming reinvestment at a rate different from the project's IRR. So what we said was that assumption of IRR, that all the interim cash flows will be reinvested at IRR, is not realistic, is not practical. That may not be practically possible. So that limitation is overcome by this modified IRR, where it allows us to punch in a different reinvestment rate. So now our discount rate can be different from the reinvestment rate at which we will be able to reinvest our interim cash flows. Advantages of MIRR. MIRR overcomes the problems associated with IRR by using a more realistic reinvestment rate assumption. It considers both the cost of financing reinvestment and the cost of obtaining funds financing at different rates. MIRR often provides a more accurate reflection of the project's profitability. While IRR and MIRR serve similar purposes, MIRR is preferred when there is a significant difference between the project's IRR and the rate at which cash flows can be reinvested or financed. So what is the main difference between IRR and modified IRR is that if we think that interim cash flows cannot be reinvested at the same rate as IRR, then IRR is not giving us a realistic picture. We can get a more realistic picture by looking at MIRR in that case and assuming a different reinvestment rate than the IRR of the project. Then the returns we get by assuming a different reinvestment rate, then the returns we get will be captured by MIRR, not IRR. So how do we calculate it? We use the function of MIRR on Excel, and we give all the cash flows first. Then we give the finance rate, that is our cost of capital, or that is the discount rate, comma, the reinvestment rate, which we expect to our interim cash flows to be reinvested at this rate of 8%, that is MIRR. So let's look at how it works. So let's assume these are the cash flows we are looking at. Minus 1000 is the present cash flow, cash outflow, and then these are the cash flows we are looking at for next 5 periods. Then what is the IRR? We can calculate it through IRR function. IRR comes out to be 19%. Now when we say IRR is 19%, it is based on the assumption that all the interim cash flows will be reinvested at 19%. So this 200 will be reinvested at 19% for 4 years. This 250 will be reinvested at 19% for next 3 years, and so on. If that does not happen, if this does not seem practical, then we should not look at IRR, we should look at MIRR. In that case, what we'll do, we'll assume a discount rate and we will put in a more realistic reinvestment rate. In that case, we can calculate MIRR as 17%. So it is lower than IRR. Why? Because we are reinvesting our interim cash flows not at 19% but at 15% only. So that is why the overall return we are getting from the project is 17%, assuming that we will reinvest at 15%. So this is the usefulness of MIRR. So to compare it with IRR, IRR is suitable when reinvestment rates are expected to be consistent with the project's IRR. So that means when we expect the reinvestment rates to be same as the project's IRR, when we can achieve that, IRR is a suitable measure of profitability. Whereas MIRR is preferred when reinvestment and financing rates are significantly different from the IRR. So when we know that we will not be able to reinvest at the same rate as project's IRR, when our reinvestment and financing rates would be different, in that case MIRR is preferred over IRR. So these are varying on the basis of three aspects. One is reinvestment assumption. IRR assumes reinvestment at IRR, whereas MIRR allows different rates for reinvestment assumption. Multiple IRRs may result in multiple values, provides a unique value. And financing consideration, IRR ignores financing cost. We don't look at cost of capital, or we don't look at the discount rate when we are doing the IRR calculation, whereas MIRR considers financing cost. So next technique we have in capital budgeting topic is payback period. Now it is a non-discounted cash flow criteria. That means it does not take into consideration the time value of money. So it cannot be the sole criteria of evaluation because it ignores a very important concept of time value of money. So let's understand what is payback period. It is the time duration required to recover the initial cash outflows. So let's say we are investing $1 lakh in a project. How much time it will take to recover that $1 lakh, that is payback period. It is the time duration required to recover the initial cash outflows. We can accept the project if payback is less than the predicted period. Ideally, we should not rely just on the payback period because it does not consider time value of money. So it is not that logical. It is not telling us about the profitability. It is just telling us about how much time it takes for us to recover our initial investment. This is more relevant for industries where products get outdated quickly, such as fashion and computers. Will prefer to use payback period. So those industries where the changes are very frequent and we need to move the inventory, we need to generate sales quickly, otherwise our products could become obsolete and new technology can come in, new trends can come in. So in case of such industries, it is better to use payback period becomes important. The quicker the payback is coming, the better it is. Simple method, easy to understand and use. However, the cash flows after the payback period are ignored. So that means if payback is happening in 3 years, all the cash flows after 3rd year, 4th year, 5th year, 6th year, all those cash flows are ignored, and it also ignores the time value of money. So used only for preliminary screening of the project. So this cannot be the decision making technique. like NPV was, PI was, IRR was, but this has to be just used to do the initial screening, just to get an idea about how many years, how much time it will take for us to recover our initial investment. In some cases, in some industries where time is very, very important, this can come into picture for those kind of industries. Let's look at an example to understand this better. Let's say company has invested $1 lakh in a project, and following are the expected after-tax cash flows. So payback period is when are we able to recover our $1 lakh. So after year 1, we recovered $20,000. After year 2, we recovered a total of $50,000. After year 3, we in total recovered $80,000. So after third year, only $20,000 are more to be recovered, and in the fourth year we are generating 40,000. So that means in half of the fourth year we'll be able to generate 20,000. So the payback period comes out to be 3.5 years. So that means it is taking us 3.5 years to recover our initial investment based on the cash flows of the project. That is how we calculate payback period. Few features of the payback period: simplicity. It's very simple, easy to understand, easy to use. It costs less than most sophisticated techniques that requires a lot of analyst time. The risk of the project can be tackled by having a shorter standard payback period, as it measures guarantee against the loss. The emphasis in payback is on the early recovery of the investment. Next we have is discounted cash flow criteria, discounted payback period. So one of the limitation of payback period was that it ignores the time value of money. Now that limitation is overcome by looking at discounted payback period, which is present value of cash inflow to measure the time required to recover the initial investment. The concept is the same as the payback period, except for the cash flow used in the calculation is the present value. It is the method that eliminates the weakness of the traditional payback period. Let's look at an example. So here Kim Corporation is considering an investment of $750 million with expected after-tax cash inflows of $175 million per year for 7 years. And we need to calculate the payback period as well as discounted payback period. So we'll first calculate the cumulative cash flows. So we can see that we need to recover 750. Out of that, we recovered 175 in first year. So remaining to be recovered is 575 after year 1. After year 2, 400 is still to be recovered. After year 3, 225 is yet to be recovered. After year 4, 50 is yet to be recovered. So we only need to recover 50 more. And in the 5th year, the amount we are able to generate is 175. So we can clearly see that payback period is more than 4 years, but less than 5 years. So how do we calculate this? This would be calculated as 4 plus, what is the amount yet to be recovered? 50 divided by what is the amount we are generating next year? 175. So 4.29 is the payback period. That means it is taking us 4.29 years to recover our initial investment of $750 million. Let's look at discounted payback period now. So for discounted payback period, we consider discounted cash flows. And we'll do the same thing again. So if we look at time value of money, we look at discounted cash flows, then how much it is taking for us to recover 750 based on discounted future cash flows. So now it is taking us more than 5 years. So based on discounted cash flows, it is taking us 5.88 years to recover our initial investment of 750. This is discounted payback period. So next capital budgeting technique we have is accounting rate of return, ARR. This is a non-DCF criteria. That means it does not take into consideration time value of money, and this is relying on accounting profits. So again, cannot be the sole criteria we are looking at. Ideally, it should not be, because it is not considering time value of money and it is not considering the incremental relevant cash flows. Rather, it is relying on accounting profit, accounting entry of profit, which we do in the income statement. So what is the PAT we are able to generate from the project? Based on that, we are going to evaluate the project using the ARR technique. Accounting rate of return is the average rate of return for different years for the whole life of the project. So that means if the project is of 5 years, what is the accounting profit it has generated for 5 years? And what was the initial investment? Based on that, we will calculate the accounting rate of return and compare it with our pre-specified return. It is the ratio between the net profit after tax and the amount of initial investment in the project. Acceptance rule is ARR should be greater than pre-specified rate of return. ARR on average investment is equal to average profit after tax upon average investment into 100, and ARR on initial investment is average profit after tax upon initial investment into 100. Accounting rate of return is a simple method and easy to understand. It uses accounting information as revealed by the financial statements to measure the profitability of an investment. However, it ignores the time value of money and hence not suitable for scientific decision making. Let's look at an example. Initial investment in the project is rupees 50 lakhs with life of 5 years. The PAT for the project for next 5 years is 7,50,000, 8,20,000, 7,90,000, 8,90,000, 6,50,000. So what we'll do the average PAT. We'll calculate the average of these values. The PAT we got for 5 years, the average of this upon 50 lakh will give us the accounting rate of return, which is coming out to be 15.6%. So now we will have a pre-specified return that I want at least 14% ARR from the project. So if our pre-specified return was 14%, we will say this project is actually generating more than 14%. So we will go ahead with the project. If the pre-specified return we wanted was 20%, we will not go ahead with this project. Simplicity, it is simple to understand and use. It does not involve complicated computations. This can be readily calculated from the accounting data. No adjustments are required. This incorporates the entire stream of income in calculating the project's profitability.